I'll be your moderator today in today's session, which we're titled Investment to Unlock a Low Carbon Ammonia Future, hosted by RMI in partnership with the International Fertilizer Association. We're thrilled to have you join us for this third installment of our webinar series, The Journey to a Green Ammonia Future. In our previous two sessions, we've explored both technology and innovation trends shaping the ammonia landscape. Today, we're going to turn our attention to the role of finance and investment in catalyzing global opportunities for low carbon ammonia. This is an essential step, obviously, for making innovation and technology, which we talked about before, a commercial reality and allow us to kind of move on to a greener future. Quick housekeeping note before we dive in. This session is being recorded. It will be available on RMI's webpage within 24 hours. We'll also send a recording to everybody who's been registered for this webinar. Another housekeeping note is throughout the webinar, please don't hesitate to submit your questions using the Q&A function on your screen. We'll do our best to address as many of those questions live during the Q&A portion of this hour we're going to spend together. Before we begin, just a brief word about RMI. We're an independent, nonpartisan nonprofit that transforms global energy systems through market-driven solutions to secure a prosperous, resilient, and clean energy future for all. In collaborations with businesses, policymakers, funders, communities, and other partners, we drive investment to scale for clean energy solutions, reduce waste, and boost access to affordable clean energy to enhance energy security, strengthen the economy, and improve people's livelihoods. We work extensively with industry stakeholders around the world, including the development of green hydrogen, green ammonia, and other critical feedstocks for fertilizer and heavy industries. We're proud to be co-hosting today's webinar with the International Fertilizer Association. Founded in 1927, IFA is the only global fertilizer association with over 500 members across 80 countries. IFA plays a key role in promoting the efficient and responsible production, distribution, and use of plant nutrients worldwide. So let me go ahead and switch to our panel. We're going to begin with about a 40-minute moderated panel featuring Tara Shervani of the Global Lead for Transition Finance at IFC, Mersha Geisis, the CEO of Namibia Hydrogen Fund Managers, and Nabil Bonona, who leads our industry finance efforts at RMI. We're going to kick things off for our panelists to first introduce themselves, and we'll start diving into the questions. And then, again, following some of the structured questions, we'll open up the floor for the last 15 to 20 minutes for general audience questions. So let me begin with the panelists with the first question, and then as Tara and Mersha and Nabil answer the first question that I have, please introduce yourselves and your background and your companies. So first question I have for the group are what are your thoughts on the current state of play in the low carbon ammonia market? Any of the three want to start? Can I pick on Tara to start?
Sure, Brian. Thank you so much for the opportunity to join. It's a real pleasure. By brief way of introducing myself, my name's Tara Shervani, and I lead the work around transition finance at IFC with a focus on emerging markets, and very much interested in looking at these transitional activities that can help hard-to-abate sectors move towards low-carbon economies. And I think the opportunities around low-carbon ammonia are some of the most interesting ones in the market that we're seeing. Certainly at IFC, we're seeing low-carbon ammonia more from a theoretical potential, very much in early stage implementation, particularly in regions with a lot of penetration in renewable endowments and energy and an ambitious, robust policy support ecosystem. But I would say for us, it's still a tale of two markets when you're looking at emerging markets, because on the one side, it does have a lot of impressive momentum, and there are early anchor projects which are emerging. Technology readiness is also improving, and governments are stepping in with the right enabling framework. But on the other side, for the markets that we operating, the business case still remains fragile, I would say, right? So there is still limited offtake certainty. There are issues around upfront capex cost and the lack of clear trajectory of whether we can use carbon pricing in a way that supports wider enabling ecosystems in emerging markets. But I think that still it is a very important transitional investment opportunity, and there's a growing recognition that it actually can play a dual role. So, one on decarbonizing existing fertilizer use and opening new trade corridor opportunities as a hydrogen carrier. But there is a real question about how we can enable this through the right concessional finance, public-private de-risking mechanisms that are relevant, and how we can help markets move from building the demonstration effect towards bankability in a more faster mainstream ecosystem. I'll stop here, but really interested to hear from our other participants on how they're seeing the market evolving.
Right. And Mercer, you're kind of on the ground in country driving, driving these projects. So what's your point of view?
Yeah, thank you very much for the opportunity. So I'm Mersha Gaisis. I work for Namibia Hydrogen Fund Managers, which is a joint venture between Climate Fund Managers, a Hague-based fund manager, and the Namibian government. And we were really established when the Namibian government had launched their green hydrogen strategy, both the Namibian and the South African governments. We've got a presence in both Namibia and South Africa through Namibia Hydrogen Fund Managers and South African Hydrogen Fund Managers. And the Namibian government launched this green hydrogen strategy, which was seen as extremely visionary and ambitious, given that we're a frontier market. Everybody was asking, so how are you going to do this? And we formed this joint venture to unlock funding for the Namibian and the South African markets, given their very good renewable energy endowments. But if you look at what's happening, I attended the Africa Green Hydrogen Summit in Cape Town last week, and we are at the Africa Energy Forum now. So both Namibia and South Africa has got two different use cases for green hydrogen and low carbon ammonia, with South Africa offering an excellent opportunity to use green hydrogen and ammonia, low carbon ammonia, as part of their just energy transition and to reindustrialize their economy. And that's really the use case. And we're seeing very good projects coming upstream now, and Climate Fund Managers have just launched last week or announced funding to a big project here in South Africa, which is Hive. In Namibia, we have got 4 or 5 different projects, and what we have done differently is that in order to de-risk these projects, we have gone into constructing pilots, of which a green fertilizer pilot is one. We've got another pilot that is using hydrogen as a reduction agent in iron ore. We've got another pilot that works on the mobility sector, or that is demonstrating a use case for the mobility sector, and an additional pilot that is just looking at ammonia for export. So we definitely see consolidation in the projects, and the projects with stronger strategic equity partners are the ones that are coming through, whilst the rest are kind of falling off the bandwagon. So thank you.
Thanks, Marcia. And last, Nabil, you've done a lot of project work around the world on fertilizer. How are you seeing things in the state of play?
Yeah, thanks, Brian. Thanks for having me today. So I'm Nabil Benuna. I lead our industry transition finance work at RMI, focused on improving the bankability of industrial decarb projects and improving their representation in investment portfolios, backgrounds in project finance investment banking. So to me, I want to kind of underscore the points Tara was making around global trade. I think that's a very interesting dynamic here. So as was already mentioned, ammonia is kind of emerging as a likely vector of choice to transport hydrogen across the globe. But interesting in and of itself is ammonia in global trade. So I think that represents really a unique opportunity for cross-sectoral collaboration in the ammonia sector, with emerging use cases, beyond fertilizer and into shipping and power and the specialty chemical sector. So that really has an implication on the global competitive landscape for ammonia supply and demand going forward, which has impacts on how the decarbonized fertilizer sector develops. And I really think that creates a unique opportunity beyond the points that were already made for kind of shared infrastructure and regional planning, and really an opportunity to share first mover risks across not just different sectors, so you don't have to concentrate the risk of moving first in the low carbon ammonia sector into the fertilizer space, but you can share that risk in a pretty unprecedented way across different sectors of the economy. And then through trade, share those risks across different regions as trading partners are able to collaborate to develop projects that have shared benefits across regions, but also shared risks to kind of buffer those and diversify them across trading partners and historical trading allies.
Great. Well, thank you. So let me shift to the next question for the group, which is what's working and what's not, right? You've mentioned, all three of you mentioned projects, and there's a lot of projects that are in kind of planning, pre-planning, demonstration, pilot phase. So what's helping those move forward, but also what are some of the headwinds that are, causing them to stall and not move as quickly as we would like?
I'm happy to jump in first on this one, Brian, since I went last on the last question. So I think what's moving projects forward at this stage of the market is really stable demand profiles that don't require outsized CapEx on the demand side. So you see that across lots of sectors in the industrial decarb sector. So you see quote unquote drop-in fuels or drop-in solutions moving first because the demand side, it doesn't require the demand side to behave vastly differently than they already are. I think another catalyst in the sector is really strategic investments from corporates that derive several sources of value from investments beyond the economics of the individual asset, and also stand to capture a large amount of upside if certain versions of the future materialize. So on sort of the downside, what's holding back is that there really is a tension between achieving economies of scale to drive down costs and introducing additional supply chain complexity. So I talked about international trade, but in order to develop large volume mega projects, you also need to develop large global supply chains, and that introduces all types of project on project risk, which compounds risk exposure, which investors don't like. So you get a lot of upside from being able to trade internationally and capture sort of the highest willingness to pay it as it emerges. But really, with every new step of the supply chain you introduce that's never been done before, you create all of these poorly understood risks. So that's why really under certain circumstances, particularly in the fertilizer industry, for example, distributed solutions are appealing.
Mm-hmm.
I'd also say there's a tension between engineering and product attributes. So you see in a lot of sector areas of the world, really regulation driving what product is being produced. And unless there is clear regulatory certainty, then the project developers don't know what to engineer their facilities to produce. So in a lot of ways, the policy is driving what the product specification needs to be, which creates this sort of chicken and the egg problem. And then finally, I'd say from the green side of things, power systems configurations, in certain regions are very difficult to manage and for investors to get comfortable with.
Great. Marsha or Tara?
Yeah, thank you. I think what is working from a financing perspective that helps to propel this projects forward is the fact that we've had significant support from governments, public institutions, and donors in order to provide project preparation facilities, because I think because of the nascent nature of the sector, there is huge work that needs to be done, or big piece of work and funding that is required to get these projects to a final investment decision. And in South Africa and Namibia, climate fund managers have raised 150 million euros from the government in the Netherlands as well as the European Union in order to help these projects to actually get through this valley of death, kind of, which is the initial phases of establishing and proving feasibility, and that has helped us significantly. As I've said, the pilots that we've built is also a very big de-risking element. But what is not working at the moment is that many of the projects that are looking at exporting into the international markets, and Europe in particular, there's no clear demand signal coming out of Europe. The regulatory changes that we're requiring to back the energy transition is delayed significantly. If you look at RED 3, for example, the countries in the European Union were supposed to submit their RED 3 targets by the 25th of May, and most of the countries have missed it and not met the targets. The International Maritime Organization is another institution that we look at to establish demand signal. There seems to be a lot more drive in the shipping sector, but really the commercial and market risks is the single biggest thing that's not working at the moment, because technical designs are kind of within the domain and the control of the investor and these donors that are providing project preparation facilities.
Got it. Thanks. Can I maybe just ask you that on the $150 million euro, was that for just project preparation, the fund, or was that also to actually do, to put capital to, put steel in the ground to do demonstration projects? So is it kind of for both?
Yeah, it is for both. And what we do is that once the projects mature and they reach FID, we could convert part of the project preparation facilities into first loss capital as we are deploying a blended finance model. And I can talk to that a little bit later.
Yeah, great. Well, looking forward to hearing about that. Tara?
No, I think Mersha and Nabil really summarized it well. There's not much more for me to add on it. I think it's a very important point that we need to have more demonstration effects projects and have project preparation facilities backed by donor funding and blended finance sources that enable the kind of the early onset of unlocking this market. But certainly it's a bit of it's certainly a chicken and egg situation where you still have all of these lack of demand signals. And I also think actually, particularly in regions without carbon pricing mechanisms, that's even also another concern to have. But these are kind of like the drivers in any type of technologies that is, as Marsha was going through this valley of death and trying to unlock it at scale, kind of the pathways that they would take through. So really interesting and nothing really necessarily for me to add on that. I would think that was already very clear.
Okay, thank you. So let me transition to a specific question for you in relation to what IFC is doing to support decarbonization of this sector and maybe other industrial sectors. Are there any particular financial instruments, financial structures that are helping accelerate deployment of capital for these types of projects?
I think there are many different ways that IFC is engaging in the market, right? Whether it is from support through blended finance, de-risking, public-private partnerships, and there are different kind of solutions, financial instruments that would be fit for purpose, depending on our client, the capacity of the client, and the markets that we're looking at. One area I think that is kind of emerging very fast as a topic within the wider market of how to get more technologies in the hard-to-abate sector financed is through the opportunities through transition finance. So transition finance, we look at this as really kind of helping these hard-to-abate sectors transform towards net zero in an ambitious timeline of 2050 and slightly above that, right? So it is not only supporting investments into transitional activities such as low carbon ammonia that would help hard-to-abate sector companies get onto that sectoral pathway so they would be more likely to reach 1.5 degrees. it's also supporting these clients that may have already set science-based targets, short-term and medium-term, to get to net zero, also get the relevant support from the market and credibility that it is the right pathway to invest into these types of technologies. So we're really kind of looking, particularly when we're talking about transition finance in emerging markets, where, as you know, the needs for decarbonizing hard-to-abate sectors are the biggest ones. We're really trying to see how this type of new instruments can help unlock some of those more material shifts we need to see from brown to green. And I think that low carbon ammonia is really one of those examples that if you want to see those shipping companies, fertilizer companies have a realistic chance of reaching 1.5 degrees, those technologies are crucial. And being able to tie this in with credible transition planning that these entities will need to put forward is only just making the business case stronger, that those technologies are not only demonstration effects, but also something large at scale that we want to support. And this is the right pathway forward to help them reach 1.5.
Got it. Thank you. And transitioning to Mersha, what are you seeing in terms of investor appetite for low carbon ammonia projects on the ground in Namibia? Again, what types of capital are you aggregating and bringing to those projects to enable them? And I think you talked about that a little bit in your previous answer. So looking forward to hearing your thoughts.
Yeah, thank you very much. I think the first tranche of capital that we always raise is development capital so that we can get these projects through the development phase right to FID. And with that, we also help the projects to get to IFC compliance standards. We make sure we've got the highest levels of ESG and make sure that the projects are actually attractive for international investors and ready for investment by international commercial investors, because these projects, by virtue of the scale, requires a lot more funding than what we can raise domestically or regionally. That's the first thing. I think the second thing is our construction equity fund, which is a blended finance vehicle. And that construction equity fund has got various tiers of capital. So the first tier of capital is what we refer to as the first loss capital. And that's the high risk capital that comes from either the same donor organizations or the likes of the Green Climate Fund. And it comes in to take the first loss and to actually make sure that we've got this tier of capital that can absorb the first loss. Then the second we have is the commercial investors that are coming in with tier 2 capital. That's now the ordinary private equity type of risks that you take. And we've got senior equity at the bottom, which is what we refer to as tier 3 capital. So the blend between tier 1 and tier 3 is actually de-risking and maximizing returns for tier 2 investors, which are the normal commercial investors, to come in the absence of tier 1, which is first loss, and tier 3, which is kind of the senior equity coming in at a much, much lower cost. You would not have the advantage or the benefit of blending and the ability to attract commercial investors to come into a nascent sector and take construction equity risks. Mm-hmm. In the absence, as I said, of the blending. And we believe that blended finance is a key solution to attracting investments. And we are seeing some risk appetite statements coming through from major pension funds as well as DFIs now in the green hydrogen sector. I think insurance companies have got another significant role to play in advancing insurance cover and credit guarantees that are required to de-risk investments in this sector. So there's a blend of instruments that we're using that are not really conventional, but blended finance has been an established financing mechanism or fundraising mechanism to de-risk nascent sectors like this.
That's interesting. What are the relative size of those tier 1, tier 2, and tier 3 buckets of capital? How big are they in relation to each other?
Yeah, so we're looking at raising a $1 billion fund, each for Namibia and South Africa, given the size of the sector or the capital expenditure in the sector and what we are required to support here. So if you blend it, we've got about 20% being first loss capital, 40% being the ordinary equity in the middle, and 40% being the senior equity. So that's the blend. It's always a basket of 20, 40, 40, which brings your weighted average cost of capital down and can really provide a funding solution for projects, because the cost of capital is a significant input into the levelized cost of hydrogen or ammonia at this point in time. And unless we bring that down, we're not going to be able to produce green hydrogen or ammonia competitively in both the Namibian and South African market, despite our excellent renewable energy endowments. So levelized cost of hydrogen is the ultimate output, and we are raising capital to keep the competitive edge that the countries have in producing green hydrogen.
Right. And do you still, other than bringing, I mean, you're bringing the levelized cost of energy down through, obviously, that mainly that tier one capital you're bringing in, the stop loss, or the first loss. Do you also need to rely on other incentives to make the projects pencil out, or is that enough to get it to pencil out, just the capital stack?
Yeah, no, as I said, we look at for insurance guarantees to make sure that we reduce the risks if any still remain. So obviously operational risks, construction risks, and a few others. We look at guarantees to back the debt that these projects need to raise, because we only bring in equity. So they still need to raise debt, and for that we get some guarantees through in order to reduce the cost of capital. Yeah, but we've got a number of instruments that we blend to bring the cost down, the cost of
Great.
capital down.
Thank you. Nabil, what are you seeing? What are some examples of financing models that you've seen both in this sector, but maybe other sectors, given the breadth of the types of projects that you've been working on?
Yeah. So I think just to take a step back, I think until the market matures, just to underscore again, there really has to be a focus on improving the predictability of cash flows and reducing technology and regulatory risk exposure. I think we talked a little bit about some of the concessional capital solutions that are designed to mitigate some of those. There's also a question I saw in the Q&A around technology, current state of comfort with technology, and the result of feasibility studies. I think you can have a pristine feasibility study, but it's no substitute in the long term, again, for operating data. And there's going to need to be a bridge between, the current state and just full transparency and great data on to mitigate technology risk and really strengthen that comfort with cash flows in the long run. But as an example, I think I wanted to point to sort of the policy in Japan, which created a highly effective, in my opinion, demand side incentive. And as part of that design, and this was related to hydrogen and ammonia projects, but Japan is meant to be or expected to be a net importer of ammonia/hydrogen. And so that in order to unlock that sort of demand side incentive, the policy requires a strategic investment in the production facility by a Japanese company to unlock those benefits. So I think including a strategic demand side investor into a supply side project really relieves pressure on the rest of the capital stack, while sending a strong signal that facility is going to be central to any organization's strategy in the long term. Then I'd say anything else to reduce the risk, and again, some of this was talked about already, but anything to reduce the risk and attract a higher proportion of cost-effective, mainstream private capital is helpful at this stage of the market. So beyond what was already discussed, things like equipment loans, things like being able to wrap the EPC contract, because full wrap EPC contracts are hard to come by, but that reduces pressure on the cost of construction financing, for example. And then insurance products to mitigate technology performance. All of those things can work together to create an overall bankable package. I think that insurance point in particular is difficult to manage. So in the early stage of the market, you don't have enough instances of a particular project risk in a portfolio to create a truly, a diversified set of exposure to kind of manage the cost of that insurance product. So I think additional support for the insurers is important at this stage of the market. And then I think finally, being able to securitize the climate attributes is going to be really important, critical to capitalizing the production facilities. There's still a good amount of work that needs to be done before you can separately contract for an intangible climate attribute and use them for upfront financing. I think there's a lot to be learned from the aviation fuel space, which is starting to make some progress on that front, treating the climate attribute as a co-product rather than bundling it into the initial product to kind of diversify how you're able to securitize those revenues is really helpful to raising an overall capital stack. And then I just wanted to also add long-term, ammonia could really be one of those commodities. And this is, again, long-term, but where having a long-term fixed price contract will be less critical because it's such a versatile product. So, we, I think, should all be aiming towards like a fully commoditized, mature market. Still a lot to be done there, but beyond, in terms of trying to identify new sources of value that can go into raising capital effectively, beyond the terms of the offtake contract itself, is the market really properly accounting for the value stemming from the growth in the low carbon fuel industry for shipping, for specialty chemicals, in the significant upside of catering to the global market for hydrogen demand once ammonia cracking technology matures. I also think part of that overall bankability package and understanding the value is really, ammonia is uniquely positioned, and I'm alluded to this before, but there's really downside protection for the cash flows because in the worst case scenario, you can sell it into the existing gray ammonia market and get some sort of cash flow. That's not the case for every low carbon fuel out there. There's also a lot of upside in the value of the connective infrastructure that a project needs to invest in, such as port infrastructure and storage. So there's ways to attract private capital into sort of the ecosystem of assets that are needed to make, an isolated asset bankable, because an ammonia storage facility, for example, will have value regardless of the development of the green ammonia space. So there could be ways to attract private capital to build out the supply chain and support, new first of a kind assets on, the supply side, for example.
Thanks, Nabil. So you talked a lot about, all three of you talked a lot about risks from supply chain to technology to, commercialization, contracting. How are investors thinking about those risks? And maybe if you can talk about how investors are thinking specifically about technology risk, and I know you even need to probably unpack that, right? Depending on what, how you're making ammonia. But maybe start there, maybe how investors are thinking about the technology risk, and then also can you talk about the technology risk in comparison to some of the other risks that you've talked about, supply chain, commercial, credit, right? Credit guarantee, all of those things. So help me understand technology unto itself and the risks, and then place it in the context of some of those other factors. Is it at the top of the list, bottom of the list, in the middle of the list of risks that investors are worried about? I know it's a lot. So this will be the last scripted question, then we'll open the floor up for some of the Q&A.
Yeah, I think if I could take that question from where we're sitting, I think it was a top of the list risks until we started doing some technical designs, and discovering the technology. And many of the technology providers, especially those that are providing the electrolyzers, the ammonia synthesis units, and the rest of the technology, are saying that this technology has been used across the world for at least the last 40, 60, or 70 years. It's just not, probably not at the scale at which we are looking at deploying it now. So how you deal with the technology risk when you scale these projects is to make sure that you build it in a modular fashion, and that's how you kind of de-risk the technology. I think the integration risks from a renewable energy perspective is one of the key technology risks that remain. But if you ask us as investors today, having gone through a number of feed studies, it would be kind of a middle of the list risk. The top risk is market and commercial risks and ESG risks that we need to manage in some of these jurisdictions, but it's definitely not a technology issue for us anymore, given the work that we've done and how far we've come in the feed studies of various projects.
Got it. Thank you. Tara, Nabil?
I'm happy to jump in. So for me, and I've alluded to this earlier in the conversation, but there is no good substitute for real operating data. So you can tell a great story around that technology's mature, but unless there is a pure exactly comparable at scale commercial facility that has provided data, most mainstream forms of capital are not going to give you 100% credit for those cash flows. So those will always come at a discount. Furthermore, there's a tension between, you can predict cash flows from, the one or two contracts that you have, but if the capital stack required to finance the facility up front is dependent on, several other ancillary revenue stream, including the ability to monetize, regulatory support mechanisms, then depending on the proportion of the cash flows that you're depending on, the technology performance will have a different emphasis will be emphasized at a different level. So 50% of your cash flows need to come from a public incentive, then you have a lot more regulatory risk exposure potentially than technology risk exposure. So it's really important to think about the full package of cash flows when evaluating the importance of the technology risk. I'd also say that, finally, most mainstream capital providers just don't take technology risks. So are we asking, banks and other types of investors to behave differently? That is, I think, a whole other, topic to cover. But I think it might be worth having that conversation on sort of what do we want the role of banks to be going forward and what their role is in the energy transition. But in the current status quo, there's sort of a full, you need to come with a full package of solutions beyond just the technology abatement in order to get closer to bankability.
Tara, any thoughts?
No, I think it was, it kind of was really well summarized. I think that, we see a lot more when it comes to instruments. I think on our side, we see a lot more outcome-linked instruments as well. So it doesn't necessarily address the topic of the technology risk, but when it comes to lowering the risk of decarbonization outcomes, we see quite a lot of promise in things like sustainability-linked loans, transition bonds, where the cost of capital is very much specifically tied to specific decarbonization outcomes and metrics to create more tangible accountability. And I think this is where the market's moving broader, which is also, I think, something where we see the rising appetite for more risk-sharing facilities, right? So there is a lot more interest now for large infrastructure projects where we're exploring facilities that crowd in commercial lenders by covering specific risks, so whether related to construction, offtake, or regulatory volatility. This is kind of coming more into play as we want to make the risk return profile of these projects more digestible to institutional investors. So I totally echo with the points of Mercia and Nabil around the widening question around the role of banks and institutional investors. But really, I think where an emerging market this is playing is just really kind of seeing how we can unlock the market at scale. And that's not only a question around capital, but it's a question around a lot of different things, regulatory incentives, innovative structuring, transition planning, risk sharing, regulatory considerations that also come into mind so you are able to really crowd in more institutional investors.
Great, thank you. Well, I'm looking at a few of the Q&A questions. Let me kind of go into two different vectors here based on some of the questions. One is, you guys talked about offtake and that being obviously, a big consideration and, in light of all the different types of risks. And there's just a question around there that we have around the capacity that needs to be secured, right, to kind of have a project go forward. I know that's obviously a moving target because we've seen some that are 100% offtake signed, and then there's a, project in close to where I live in the Gulf Coast, Texas, that actually is being done on balance sheet with no long-term offtake. But in general, what is kind of the sweet spot in terms of the capacity that people are striving for to get the right balance of, the expected return versus the capital that's signed up, right? What are just some rules of thumb and what you're seeing in terms of what makes a project go? How much percent needs to have long-term contracts behind it of the volume?
Yeah, I think that is a significant challenge in itself. Just saying long-term contracts is a challenge in itself. I think for the green fertilizer industry and the market, it is possibly easier than the other green hydrogen derivatives, such as synthetic fuels and ammonia as a carrier. So I think the investment banks and corporate financiers are used to long-term power purchase agreements, for example, and that's how many of the funding structures are set up and backed up. But here we've got a 10-year challenge in the first place because the off-takers are not willing to look at long-term off-take agreements just because they're coming in upfront and the price might change or reduce significantly, and they don't want to lock themselves in for the higher price levels which they think the green ammonia or green hydrogen is trading at now. So we are looking at a lot more shorter term contracts. So that's the big thing. And if that is the case, then we foresee a situation where these projects will not see the rule of thumb or conventional debt equity ratios of 70-30. We might have to put in a lot more equity just because we're not seeing the long-term offtake. But in the green fertilizer space, I mean, there could be longer term offtake agreements, and that shouldn't be a challenge. But for the other derivatives, it is a significant challenge. 10-year is a challenge, yeah. So we don't know at what level you should be, and because of that, we think we'll have to put in a lot more equity to get to the bank's risk appetite to fund this.
Right.
Yeah, I can add a couple points too, because I think one of the challenges in nascent markets is that it's pricing transparency is really difficult. So even if you are getting pricing signals, the terms of the underlying contract are always bespoke. So there aren't standard contracts. So comparing one pricing to another, comparing one contract to another is really difficult. So I'd say the strength of the commitment is incredibly important in answering that question, because you can essentially, fully substitute technology risk for counterparty credit risk exposure if you have a take or pay firm take or pay contract where the off taker says, I'll pay no matter what, even if the molecule doesn't show up to my facility. So that is a substitute, but that is a lot to ask the demand side to take on. So if you have a high margin product with a highly credit worthy counterparty, you can probably get away with a shorter term contract because you can pay back all of your investors and your interested parties in a shorter time horizon. But if you have a lower margin product where the financiers are haircutting all of your cash flows because of the risk exposure they see, then you probably need a very long-term contract in order to be able to discount those cash flows back to the amount of capital that you need to build your facility. So I'd say those are some of the major dynamics that factor into the equation. But there's a trade-off.
Yeah. Well, let me switch here. There's a lot of questions about technology here, kind of a general around what do we think about technology, one around emerging technologies, plasma catalytic synthesis, modular systems, blue versus, production methods, blue versus green. How how are you thinking, how are investors thinking about all of those different technologies that are there, are there investors that are supportive of some more than others? And how do you think about stratifying, again, those technologies on the spectrum of kind of lower risk, more proven versus still, still a lot of risk that a lot of de-risking that needs to happen before you have investors come in? Any takers on this question? Mersha?
Yeah, I think it's a very broad question. I saw some question on the on that plasma catalytic ammonia synthesis or whatever. So there is no specific preference for a specific type of technology. I think whatever works in a specific setting and jurisdiction, and specific climate conditions, and whatever the country's competitive advantage is, that's what we're going to be deploying. So if you talk to many of the operators in the sector, and you visit their pilot projects, they'll tell you why they've selected a PEM electrolyzer. The others will tell you why they've selected an alkaline electrolyzer, but both are actually doing the same thing. It's all about efficiencies and what works in a particular context. And I think that's how we are proceeding with that. What we have seen happens is that many of the investors are actually preferring kind of tested and existing technology, such as the Haber-Bosch technology. The Haber-Bosch process is tested, it's trialed, and it works, and that's kind of a de-risking factor for them. But it doesn't mean that they're not looking at the newer forms of technology. If it's too new, it probably will just take a little bit more time to get to a final investment decision. But currently, I don't see a preference of one technology over the other, or one country's technology over the other from an investor perspective. It's all about the context.
Got it.
And I can add a little bit of color too on this topic, although I'm not a technical specialist, more on the finance side, but thinking about the interplay between technology and transition risk exposure. So, and how that relates to the length of the off-term agreement. So if in any way the technology is perceived to be cost competitive for the moment, and that it fits into an entire supply chain of activities that result in a cost competitive product to the end user at this stage of the market, it's also important to think about what the state of the market is going to be at the end of the length of the term of the offtake agreement. So to assess what sort of recontracting risk exposure the project has. So is this technology fit into this specific supply chain going to be competitive in the long term, or is this facility, because of the expected improvement of the technological competitive landscape, going to have trouble, signing a contract at a cost competitive price based on new forms of competition, either from a technology perspective or even from, if we're talking about a global trade perspective, are there going to be, new regions getting into the game 10 years from now, or 5 or 10 years from now, that have, access to more competitive fundamentals from a feedstock perspective that are going to make recontracting really difficult. So I think it's important to think about the interplay there.
Thank you. What, just kind of another question. Where are we seeing the most competitive projects? What regions, both blue or green, right? That is close to the price of gray right now, gray ammonia right now. And what is, are there some that are kind of without incentives, or with incentives, with some of the national, subnational incentives at cost parity with those projects, and kind of where would those regions be around the world? And where should this market develop first?
Yeah, thank you. I see the audience is also asking, why are you equating low carbon ammonia, which is with gas, to green ammonia? I mean, we don't have gas in our jurisdictions, and we're only looking at producing green ammonia. The countries that have gas and that has got a cost competitiveness on gas are looking at the low carbon, or the blue ammonia. So that's probably why I've been talking about the green ammonia. But based on the studies that were done, and based on publications that you'll find on the potential of producing green hydrogen, I think the jurisdictions with solar and wind resources, the likes of Chile, I think Chile is rated kind of a #1 jurisdiction. The Middle East and North Africa have got potential to produce competitively. That's now green hydrogen. South Africa and Namibia definitely have got the capacity to produce competitively. They are part of the top 3 destinations in the world. But you also got other countries in Europe, for example, such as Spain. They've got a very big competitive advantage, similar conditions. So there is a ranking of countries and proper studies that were conducted in who can produce it competitively. The countries with gas can definitely do low carbon ammonia quite competitively. Yeah.
Nabil or Tara, any comments on that question?
I would just add that there's a distinction, and I have nothing to add in terms of just the regional competitiveness, of specific production locations. But I think it's really important, in addition, to assess the end-to-end supply chain costs. I mean, that's why we think it's really important to create consensus around corridors. So to coordinate the infrastructure that's needed to both distribute and receive the product. So end to end, what's going to be the cost to transport and then distribute the molecule to the eventual end user. And that can make a really big difference in the, end to end levelized cost or competitiveness of the product, depending on the specifics of the supply chain.
Got it.
Yeah, I mean, I totally agree. I think what also is an important factor to think about, it's not only about the resource potential, and Nabil rightly already hinted to it. I think it's also about political alignment, permitting clarity, early stage planning for transport and offtake, the right ecosystem to ensuring that these markets can move to investment grade, and kind of there having the opportunity to very targeted de-risking and structured finance to unlock some of those demonstration pilots. I don't think it's only an issue about the capital moving in order to really make this a kind of a large scale market opportunity.
Right. So last question, because we're about 3 minutes left on time. And this is a broad question, but I'm going to ask you to try your best to answer it in about 30 seconds. So as we wrap up, but there's a question around what are the most significant gaps that require collaboration across private, public, and philanthropic actors? And what, corollary to that is what would you urge investors to do over the next 12 months? Like, what's the investor's role and how would we urge them to do it? So I know it's a very broad question, but please, in 30 seconds, what's your answer to those two? What needs to move?
I think the off-takers need to move. I think that's the key thing for us as investors, because many of the potential investor participants that we talk to in raising funding for our fund doesn't ask what's the technology risk or what's the ESG risk. They ask where's the offtake. So that's what needs to move. So the policy clarity in the European zone, especially for us, is quite important.
I think we need to get much more specific at the asset level on what we mean by interventions, because I think concessional capital is really important. We talked a lot about risk mitigating solutions here, but what specific assets are we talking about here? What are critical to the transition plans at the national level, at the sector level? And then how do we support specifically at the asset level projects to kind of move those broader objectives forward?
Great, thank you. Tara, you wrap us up, please.
Yeah, I think I fully agree with both Mersha and Nabil. I think that this is it's an opportunity long term, and certainly the emerging market space is one where we see already, at the regional level, quite some interesting supportive government, ambitious hydrogen roadmaps, and early stage infrastructure planning that is going to be really interesting. And I think that it's an interesting play to see where private sector investors, institutional investors, opportunities to bring in blended finance, structured finance as well as regulators to kind of kick this off at a scale and be very targeted is certainly an area where we want to see the market is moving. And I think transition finance is one of the tools where we can tie more outcomes-based solutions to also bringing more credibility and credence to these crucial low carbon technologies in the hard to abate sector space.
Great. Well, please join me in giving a virtual round of applause to our speakers and our panel. I certainly learned a lot and appreciate your time and your insights. And again, we'll post this on our website within 24 hours, so it's been recorded, and please share it as needed. Again, thanks to our panelists and appreciate the hour of your time.
Thank you very much for having us.
Thank you.
Thank you.